Good morning. It's Jeffrey Cushing of CPM Group. It's 10:30 in the morning here in New York on Friday, the 16th of May. I want to talk about some misconceptions and related to the gold and silver market today. There's a lot of hyperbole that has risen even further among the promoters. You hear terms like economic supernova and biblical upward move in silver coming. And there's just a lot of misinformation. And one of the things I want to do is actually talk about some aspects of the silver futures contract and how it trades on the COMEX to perhaps help people better understand what it is. I'm going to start with this quote from Mark Twain. Somebody has just come out with some obscenely long 1,200-page biography of Mark Twain. And having grown up downriver from where he grew up, I've always kind of liked Mark Twain, not because we were both Missourians, but because he had a tremendous amount of very good information and wisdom to share with his readers. But he said, every civilization carries the seed of its own destruction, and the same cycle shows in them all. A republic is born, it flourishes, decay sets in, and decays into plutocracy. It's captured by the shoemaker, who the mercenaries and millionaires make into a king. The people invent their oppressors, and the oppressors serve the function for which they have been invented. Mark Twain is kind of prescient. Not really. This is the history of plutocracies. And I got the definition of plutocracy here for somebody who might want to know exactly what a plutocracy is. That's where we're going. So one of the misperceptions is you keep hearing people talk about how as of July 1st, under the Basel III Accords, gold will be considered a high-quality liquid asset for banks, and that's going to cause banks to, I don't know, do all kinds of things. Buy gold and add it to their reserves, pull in gold that they're leasing out to fabricators and producers at smelters and refineries, and do other things that might disrupt the gold market and drive the price higher. None of which is true, right? There is a rule that's coming into play related to high-quality liquid assets on July 1st. It has nothing to do with gold. Gold is a Tier 1 asset under Basel III. It's not a high-quality liquid asset. Bullion banks in London have been lobbying to try to get it recognized as a high-quality liquid asset by the Bank for International Settlement, but it hasn't happened yet, right? Even so, it's not a non-event. And we've done things before. A year or two ago, you had these promoters talking about how Basel III was going to cause disruptions in the gold market, and banks would start buying and holding gold on an allocated basis because it was a Tier 1 asset. And none of it actually happened. And it's weird because you wonder, these guys who talk about Basel III and banking regulations, you listen to them and you say, are they that uninformed about banking regulations that they don't understand what's going on? Or do they understand what's going on and they just assume that gold investors don't know about this stuff and they can say anything they want and it'll be believed? It's hard to say what's really going on. The static in the market has gotten so thick that even the London Bullion Market Association has stepped in to combat this misinformation. And I put here a link. The LBMA has actually written a very good piece and posted it online, going through issues related to gold's relationship with banking. Basel III, Basel I from, I guess, 1988 was the first Basel Accord. Basel III, the HQLA issues and regulations, and things like that. So if you really want to know this stuff, you can go to this article. It's not that long, but it's very good overview of these issues. If you don't want to know it, well, it's your money. The next thing I want to talk about is silver. And you hear all kinds of crazy things. But I want to talk not so much about the crazy things. I want to talk about what really happens. And one of the things that people don't seem to understand is that COMEX silver futures markets exist to trade silver indexed futures, in essence. Paper silver, if you want to be cute about it. So the contracts trade, and there's this tremendous trading that goes on for two big reasons. One is in commercial entities, which are primarily banks and trading companies, need to hedge their financial exposure to changes in commodity prices. And silver, along with natural gas, is one of the two most volatile price commodities by price around. So if you are a bank and you are holding large amounts of silver that you've leased out to smelters, refiners, producers, fabricators, others, you need to hedge your price exposure. And you do that primarily using futures and options on the COMEX. There are other ways to do it. You can even use ETF and ETF options, as some banks have done in various times. The other reason futures exist is to give investors who want to have exposure to a commodity's price, but don't want the physical commodity, to be able to invest in that silver. And investors tend to invest long. There are not that many investors who are comfortable shorting the market. It's sad for them because they tend to lose a lot of money. But as a result, you have this tremendous volume of silver futures contracts that trade back and forth every day. I'll show you a chart on volume in a second, because there's some misinformation floating around on the bad internet about that. And I'll show you that in a second. Most of the deliveries that you see on COMEX are deliveries of depository receipts held by the COMEX clearinghouse. Somebody who is short a contract, May Silver, will go to the clearinghouse and say, I've deposited silver in a COMEX recognized depository. I have given you the depository receipt. I'm going to deliver against my short position. And then the COMEX clearinghouse will assign that to somebody long in the May contract. And that delivery happens. And then a lot of times the deliveries are to other bullion banks, and they will re-deliver it back into the market. So you'll see that same contract delivering over and over again. It's very important to understand, because what I'm going to say now, if you look at the March COMEX contract, which was an active delivery month, you saw 82.9 million ounces of silver, COMEX silver contracts, depository receipts, delivered. Some of it was duplicated, but 82.9 million ounces of deliveries in the active March. In the less active April, you saw 16.7 million ounces. And through yesterday, you saw 72.3 million ounces delivered in the active May silver futures contract. That's a total of 172 million ounces that has been delivered in terms of contracts or warehouse or depository receipts over the last 2.5 months. 172 million ounces. During that time, COMEX inventories have risen. They were 356 million ounces at the end of January. I think they got up to about 400 million ounces by the end of February. And since the beginning of March, they've risen to 502 million ounces as of 2 days ago, the most recent data for day for which data is available. So there's the deliveries of the contracts, and there's a big divorce between that and the physical metal that is in COMEX recognized depositories, some of which is registered with the COMEX clearinghouse, and some of it is eligible but not. And then there's also metal that is not eligible to be delivered, smaller bars. These are 1,000-ounce bars. Smaller bars, coins, boxes and boxes of silver eagles and maple leaves and other silver coins are in some of those depositories. This is just metal that's 1,000-ounce bars that can be delivered to the COMEX, right? And it's not just COMEX depositories where we're seeing silver stacking up. We're also seeing it at refineries. And I was watching a commentary on the bad internet today about this guy, a coin dealer, and he was talking about how he was shocked to find that the two big silver refineries in the United States actually are backed up with silver to be refined and sold. And the question, he had is, where's all this silver coming from? Well, most of it came from investors. There were investors who fell for the silver squeeze scam 2021 and 2022. The price of silver had gone from like $15, $16 up to about $29, $30. And then the smaller bars and the coins had big premia on it. So some of these people were paying $33, $34, $35 an ounce or more for small silver investments, right? Not good delivery 1,000-ounce bars, smaller things. And there were a lot of people who were sucked up by the silver squeeze and paid way too much for silver than they should have. And then by 2022, late the second half of 2022, they realized they had been scammed. The silver price had fallen to $16, $17.67 was the daily settlement low in the second half of 2020. So the price went from $30 to $17.67, and those premiums have ultimately come down. Some of these investors have been selling silver for the last 2 or 3 years, large volumes. With the price for having risen sharply since April, more of them have been selling this stuff. It's 10-ounce bars, it's kilo bars, it's little bars like 10-ounce bars and 100-ounce bars that say they're LBMA registered, but they're not, because the LBMA only takes recognizes 1,000-ounce bars. Yeah, there's a lot of scam stuff, and a lot of medallions and a lot of coins. The coins, they're official coins, maple leaves or eagles. You might be able, in your refinery, you might not sell those, melt those down and to cast into 1,000-ounce bars. You might resell those because they still have a premium. But the medallions, the non-bank medallions, the non-bank medallions, they're selling at a discount to spot. So if you're a refinery, you're going to pay less than spot for medallions, 100-ounce bars, other things, melt them down, cast them into 1,000-ounce bars, and sell them at spot for a profit. Yeah. So it's not just the depositories at COMEX that have seen this enormous surge. 150 million ounces. I'm not sure that 500 million ounces might be a record for COMEX silver inventories. They were pretty high back in the late 80s, early 90s, and I didn't bother to look it up. But, we've seen a 150 million ounce surge in the amount of silver in COMEX depositories since the end of January. And we've seen a lot of silver backed up at refineries, not just in the United States, but around the world. And there's a lot of silver that's still there. So, in summary, the contracts that are delivered to longs on the COMEX are not necessarily representative of silver being delivered and taken out of those depositories and used in fabricated products or hidden someplace else. Those contracts were delivered to longs who kept the silver in the COMEX registered depositories and have continued to trade it. They didn't move it out, or if they did, it was replaced by other metal that was coming in from other deliveries. Right? Contracts covering depository receipts get traded back and forth. They mean nothing about market participants taking delivery of physical metal and removing it from the depositories for any other reason. Anybody who tells you otherwise, is wrong. Now, another thing that is that there's a massive surge in 1 hour of trading on May 14th of silver futures, 60 million ounces or whatever, traded in 1 hour. That might be possible. These are daily trading volumes, and May 14th is this one right here. You can see that May 14th on a daily total doesn't necessarily represent a big surge in trading volume. The price of silver fell that day, but it didn't fall because of that trading volume, or maybe some of it was. But what you see in commodities and other financial markets, you saw it in the stock market over the last 2 months or so, a month and a half, what you see and what you were looking at when you see these large periods, or you see small periods of time, but large volumes of buying and selling, it's computer-generated trading, because more than 90% of the trades on the COMEX silver futures contract and most other financial markets, including stocks, are now generated by computer programs. And everybody uses the same or similar computer programs that are looking at the same price. And when you see the price fall below $33, all of a sudden, all of those computers all at once say, sell this stuff. And that's what happens. And we run through data to show you that it happens both on the rising side and the declining side. And in fact, it happens slightly more when the price is rising in a 5-minute period than it does when the price is being declining sharply. So nothing unusual there, nothing conspiratorial. And again, anybody who tells you otherwise is wrong. They're just wrong. Now, I have a couple other things that are longer term issues. This is real commodity prices, and you can see this is the commodity index, commodity price index, and it goes back to 1800. It's from, I'm not sure if we took this from The Golden Constant, Roy Jastrom's book on gold prices, or Silver, the Restless Metal, his book on silver prices. But regardless, he collected this data going back to 1800 in the United States and going back to 1700 in the United Kingdom. The United States didn't exist, so it didn't have a currency. It didn't have commodity indices. They were British prior to 1776 or so. But this is, the blue line is the nominal price of commodities index, and you can see it was relatively flat until about 1960, 1970. With deregulation, you started to see the commodity prices rise. OPEC took control of the oil price in the late 1960s, and it went from $1 a barrel up to $40 a barrel by 1980, back down, up. OPEC took control and freed the oil price from the set price that the U.S. Oil producers had used from World War II through 1968 or so. You saw the U.S. Treasury get out of the silver market. You saw the U.S. Treasury and other central banks get out of the gold market. Silver and gold prices adjusted upward. You had high inflation. You had deregulation of all sorts of industries, including agriculture. So you saw a lot of commodity prices rising on a nominal basis. During that period of time, because of high inflation, you saw the real inflation-adjusted price fall. And the real inflation-adjusted price for commodities in general has been falling since around the 1850s, since the Industrial Revolution. The first thing that happened with the Industrial Revolution was it revolutionized agriculture, and most of the commodities were agricultural. So you started to see large increases in food production and lower agricultural commodity prices as a result of the industrialization of agriculture. And whereas we had like 80% of the people involved in agriculture in the United States in the 1860s, we have like less than 5% of workers in agriculture today. But you've seen commodity prices in general fall over the long run. Now you can see slightly here, since 2019, the real inflation-adjusted price index for commodities has also started to rise too. Nominal rose sharply from 75 to something north of 100 on this index basis, and real rose from about 85 to something north of 100 too. So you've seen some increase. But when people tell you that silver is the only commodity that has seen a long-term decline in its price, well, they're wrong. Now, I think I added this because some people like to see an index to the beginning as opposed to the past. And here you can see real prices, even though, yes, we've seen an increase in 2019, they are still pretty low. And that's across commodities. Again, if somebody tells you silver is the only commodity whose price hasn't risen in inflation-adjusted terms, they're wrong. Now, I was looking for some other information in our records earlier this week, and I came across this chart and slide from a presentation I made in Malaysia in 2014. And I think it's really worthwhile. I've talked about this in the past, but all of a sudden, again, with the hyperbole and the nonsense of the gold promoters, you're hearing people talk about how the Fed or the Treasury didn't allow the Bundesbank to take gold out of the New York Fed and move it to Frankfurt in 2014. That was not the case. The metal was moved out, but that metal had been accumulated prior to 1970. What became good delivery standards in the late 1970s meant that gold that had been accumulated by the Bundesbank from 1950 through 1971 or so was not good delivery gold. So as the Bundesbank was taking the gold out of the Fed and the Bank of England and the Banque de France in Paris, it was having that gold refined into good delivery gold that would then be delivered to its own vault in Frankfurt. That was the delay. It had to do with the fact that you were upgrading or swapping that gold out for good delivery gold. The U.S. Fed, the Treasury, never told the Bundesbank it had to wait. And you don't have to believe me. You can go to this website link here, and you can find a very long presentation of CPM Group launching its 2014 Gold Yearbook. And we brought the head of foreign exchange and gold trading over to New York to speak. And he gave this talk, and you can see it, and he can say there, you can hear the Bundesbank saying, this is all nonsense. He doesn't say it, but he almost said, if somebody tells you otherwise, they're wrong, right? So there are estimable gold commentators who continue to misrepresent this situation. You can lead a horse to water, but you can't make it think. Yeah. So I thought I'd throw that in there because it's kind of interesting. Let's talk a little bit about the markets. Gold and silver are off sharply again today. They continue to fall sharply, but they remain higher than they have been at any time prior to April, at least for gold. So we're still in record levels, but we've seen the gold price go from having touched $3,500 in the second half of April. It's come back down. It actually broke below $3,100 today, I do believe. Let's just make sure there. Yeah, no, it got down. I'm sorry. It broke below 3,200. It got down to $3,156 for the June contract. CPM Group's trade recommendation, ultra short-term trade recommendation on May 1st, the last one that we issued. We'll issue a new one today. We plan to issue a new one today. On May 1st, we issued a gold trade, ultra short-term gold recommendation. We said, look, the price is $3,200 some odd dollars on that day, May 1st. We would advise investors, stay long, but if you're an ultra short-term investor, you might look to buy on dips. And we said that we thought that over the 2 weeks between May 1st and today, you might see the gold price fall as low as $3,000 to $3,150. It got down as low as $3,156 earlier today. We are probably going to issue another, similar recommendation today. From a long-term perspective, we're still bullish on gold, but for a variety of economic and political factors that have been developing, we think that the gold price may continue to decline and go back and test that price around $3,000 over the next few weeks. In addition to that, as we talked about in our last video, I believe, we are entering a period of seasonal weakness. And while we've seen some very strong economic indicators, industrial production of business equipment and business construction were relatively strong last month. A lot of that is in advance of tariffs. People bringing in equipment and stepping up their activities. Right now, we do think that you'll see a weakening of the economic environment over the course of the next 6 to 9 months, and you will see investors continuing to buy gold and silver because they're concerned about the state of the economy as well as political issues. But we have seen the price come down. As I said, it got down to $3,156 today. From a long-term perspective, that's may well be a good price, but from a shorter-term perspective, we wouldn't necessarily jump in the expectation that the price is going back to $3,500 in the next couple of weeks. Those trade recommendations, generally speaking, are for 1 to 2 weeks. Silver prices continue to underperform gold. Not surprising. I'm just talking about all of the silver that is around. A lot of stable liquidation that has been occurring since the price got over $33 in February and March. That continues to be the case. Demand for silver is weaker in most parts of the world. It's a little bit stronger in India and it's a little bit stronger in pockets of the United States, but we've seen investors sell this stuff off. It has relatively good support around $32, but it did fall below $32 this morning. It got down to $31.98. This morning, it's trading around $32.21 for the active July contract right now. So silver has that same vulnerability. You can see it fell very sharply in early April after Mr. Trump's wonderful tactical tariff announcements, or threats or extortion, whatever you want to call them. Platinum and palladium continue to tread water. Our view is they will continue to tread water. The auto industry, which is the major use of both platinum and palladium, continues to face short-term cyclical and long-term secular headwinds. And we're seeing a reduction in the amount of platinum and palladium that is needed for autos, and investors are responding accordingly. Same true for palladium. We will be launching our Silver Yearbook on 2 weeks from now, on May 27th. There will be a place where you can register to participate in the online briefing, Silver Market Update, and Silver Yearbook Briefing. There will be a place on our website where you can register to participate. Next week, I'll be out of the office for 3 days, 2 days attending the Current Trends in Mine Finance seminar that the Society of Mining Engineers New York chapter puts together. I think this is the 10th year now that they've been doing this. And then I'll be out on Thursday because of Murdoch Capital Partners having their Precious Metals and Critical Materials Conference. I'm speaking there, speaking at the Astrologers Fund. We probably won't do a video on Tuesday, and we probably will do one next Friday. In the meantime, you can go to our website. You can order the Gold Yearbook that came out in March. You can pre-order the Silver Yearbook. You can it's ready to be registered to attend that. You can pre-order the Platinum Yearbook, which will come out in July. You can subscribe to our monthly Precious Metals Advisory. There's all kinds of free reads and videos available on that. I did a very interesting interview with the Northern Miner earlier this week, and the link has been posted to our website. Adrian Pocobelli, who does those interviews, has a way of extracting a lot of interesting historical data from me. So that's worth going to our website just to see that video. I think it's probably about a 40-minute interview. And then you can send us an email at info@cpmgroup.com. Say, I would like to find out how CPM Group can help me better manage my exposure to precious metals and commodities prices. That's all I have for now. Take care of yourself. Have a good weekend. Take care of those around you. Try to do something good for the world because there are a lot of people out there that are doing things that are bad for the world, and we need to counter that whenever we can. Take care.